Good morning, everyone. Am I audible properly? Hello?
Good morning, sir. Yes, sir.
Yeah, okay. So we will wait for another 2 minutes and then I'll start.
Okay, sir.
Okay. So now today we start with fair value measurement framework. So it is basically given by the US GAAP. Means how you are going to take the numbers to determine the fair value. Okay. So that guidance given in the US GAAP. Okay, so there is a, I mean, the valuation technique. Okay, so that we will see, and then the priority. Okay, so priority, basically, if you have a value of a identical asset, and value of a similar asset. Okay, from the market, which I means like what could be the reference for you? Means you are considering the value of identical asset, or you are considering the value of similar asset. Any guess? if you want to like value your car, you want to value your car. Okay, so you I mean you own, say, for BMW. Okay, and you have a valuation of the BMW same car. Okay, and the Audi. Okay, so maybe in past or in last 10 days, there is a active transaction of BMW and there is a active transaction of Audi. Okay, which reference you are going to take for valuation of your BMW? Any guess? Okay, you want to value your car, you have an input again for recent transaction of sale of BMW and the recent transaction of sale of Audi. So of course, if you have a value of the BMW, so you are going to prioritize. Means you are going to use the value of BMW. Okay. If you don't have the value of BMW, then maybe you can use the value of Audi and you make a certain adjustment. Like as per the quoted price, I mean, if you want to buy the BMW, okay, so it may be around 70 lakh. Okay, and if you want to buy the Audi new, okay, that price is available in the market. Okay, it may be around 63 lakh. So you know, like BMW price is always 10% high. Okay, so at this moment you have a Audi prices. So what you are going to do? Audi prices plus adjustment of 10%. Okay, and this way you need to evaluate the value of the BMW. But that is basically the second priority because you don't have a value of the BMW. Okay, so that you need to consider. Okay, so this way you can use the input. Okay, that we will see. Regarding valuation technique, either income approach, cost approach, or there is one more, market approach. Okay, so market approach, whenever there is a active market for a particular product, okay, so that market prices you can consider for a fair value measurement. Okay, so if the market information is available for a particular product or active market available for a particular product and you want to fair value of this particular product, maybe asset or liability, okay, so then you can use the information from the market. Second is basically the income approach. Income approach means what we are going to do. We need to calculate the free cash flow. Okay, and then discount with proper percentage with a or expected rate of return. Okay, so whatever may be the discounted value, present value of a free cash flow, that will be the value of your fair value of your asset or liability. Or liability. And last one is cost approach. So as we saw, if you are going to replace the asset, okay, so, then what would be the replacement value? Okay, that is basically the replacement value. Replacement value. Okay, so these are basically the three valuation technique. Okay, and here it is not the case. Means what could be the priority? This is means what is the like more reliable information available. According to that, we need to value the our asset. Okay, so if we get the proper information from the market, okay, like the shares which we are listed in a stock exchange, so those shares which are listed in a stock exchange, we can clearly get the value from the exchange. Okay, so in that situation we can use the market approach. Okay, if you have a clear plan of a, I mean what may be the inflow because of use of the asset, okay, so then you can use the income approach. Okay, and like if you can, if you are aware or you are going to replace the asset and you have a detailed information about the replacement cost, then you can use the cost approach. So here there is no priority. You can use any of the technique depend on availability of the information. Okay, so wherever you have a, I mean whatever may be the most reliable information available with you, that you can use it for considering the valuation technique. Hierarchy of input, as the name suggests, hierarchy of input. Here you need to prioritize. Hierarchy of input. Here you need to prioritize. Okay, so there are level 1, level 2, level 2 and the level 3. Okay, like active market plus identical asset. Okay, in level 2, any of the is missing, like identical market, identical asset, but no active market, or active market but similar asset. Asset. So any of the factor missing, okay, then we need to approach to level 2. And the level 3 is basically we do not have any information, then we need to use the maybe the discounted cash flow method. Okay, so it is basically we are not going to work on any information, we are calculating the value of the asset on the basis of usage. That is basically the level 3. Okay, so here I mean there is a one observable, means if you are getting in some information, okay, so that is that we consider as an observable, and the third one is unobservable, because we do not have any active information, so we need to calculate here. Okay, so level 1 again. Okay, can you give any example of level 1 input? Any guess? Any example? Gold prices, Can we consider as a level 1 input? Okay, keep in mind, whenever you are using the level 1 input, okay, you do not require to make any adjustment. Okay, so no adjustment or no adjustment oblique no modeling is required. Modeling means like in level 3 we are preparing the cash flow statement, so that is not required. Level 2, any guess? Forward contract transaction. Prices of the forward contract transaction depend on the active market for the spot transaction. Okay, so we are not getting any ready information for forward contract transaction. Depend on the active market transaction, we decide the valuation. Okay, so again, I mean, as we already discussed here, observable with no adjustment in level 1. In level 2, again observable but with adjustment. Okay, and the third one, level 3 input. Any example? Any guess? Any example? Goodwill calculation. Okay, how we are doing the goodwill calculation? If we are paying some amount, X amount, which is less than the fair value of all tangible, intangible asset. Asset. Okay, so that is my goodwill. Say for it is Y. So that it is my goodwill. Okay, so we need to calculate the goodwill. Okay, so it is not observable. Okay, so non-observable. Okay, tell me if you have level 1 input. Okay, so whether you are going to use the level 1 or you are going to calculate level 1, level 2, level 3, and whatever may be the best suitable for your approach. Okay, or your financial that you are going to take. Any guess what you are going to do? If for a gold active market is available, okay, still you are calculating with reference to silver prices. Are you going to do it? Or you're
No, sir. We have to go for the active market
active
itself.
market? Yes. Okay. So it is clear. I means if you have a level input, okay, then you do not require to explore the level 2 and level 3. You need to use the level 1. If you don't have a level 1, then you should go to the level 2. Okay. And if you don't have a level 2, means level 1 is missing, level 2 is missing, then you need to use the level 3. Okay. So it is here you need to prioritize. Okay. For technique, okay. So as we saw, market approach, income approach, and cost approach. Okay, so again, if you have the information and you can derive the prices on the basis of market approach, okay, are you still going to explore income approach and cost approach?
No, sir.
Why? Is I mean, for considering the valuation technique, are we going to prioritize?
No, because we have the active market. We have the pricing. We have the rates visible in the market. So we are not identifying through the cost and the income. If there is no market approach available, then we decide through income or the cost approach.
Okay, I'll give an example. There is a land and building. Okay, so because say for like developer develop land and building and he is going to sell at a square feet on the basis of square feet. Okay, so we have an active information available because he has a, I mean, the developer built a technology park. Okay, so he has a several land and building. So active market is available. Okay, so here you can calculate as per the market approach. Okay, but like usability of land and building is for business A is very high, whereas the usability of land and building for business B is low. Okay, so in that situation, whatever may be, like business A is going to evaluate his land and building only on the basis of market approach. So the same value for business A and the same value for business B. Okay, so in that scenario, like are both the businesses use the same value or they need to use a different value? Even though the answer is wrong, don't worry, it is just a discussion. So I have a certain point, but like I want to see you people thought process first. Say for as per the market approach, it is 1 crore, but flow business A can earn 2 crore and the business B can earn 0.8 crore. And guess, this is as per market approach.
So they use different value.
Sorry?
So they will use different value as per
Different.
their
Yes.
more reliable data.
Correct. Okay. See, there is a one more concept which is basically maybe you are aware about this word impairment of the asset. Okay. Even though you buy the asset with some prices, but if you cannot recover the cost, then you need to impair that asset. Okay, so even though as per the market approach it is 1 crore, okay, but as per the business calculation it is 2 crore. Okay, then you need to evaluate. See, if I'm doing an aggressive calculation or not much reliable, then I can use as per the market approach only. Okay, it is not the case just because I'm able to earn higher. That's why I need to raise the value of the asset. Okay, but if I'm sure that I cannot generate more than 0.8, then my asset should get valued at 0.8 and I need to make an adjustment for the impairment of the asset. That's for sure. Means as per the conservative basis of accounting, you need to book the losses as and when incurred, but you need to defer your income. So in this situation, business A case, you need to value the asset of 1 crore, means as per the market approach. But for business 2 case, you need to value the asset as per the income approach. Okay, so that's why I'm saying for valuation technique, it is not the case that you need to prioritize. It is what technique is best suitable for a current condition. Whether you need to use the cost approach, whether you need to use the income approach, or whether you need to use the market approach, that you need to evaluate on the basis of the situation or the information available with you. Okay, it is not the priority, it is the judgment actually. Okay, whereas input, usage of input, okay, so level 1 input, level 2 input, level 3 input, that is basically on the basis of priority. If you have a level 1 input, then you need to use the level 1 input only. If you have a level 2 input and level 1 input is not available, then you can use the level 2 input. If the level 1 and level 2 input is not available, then you can use the level 3 input. Clear?
Yes, sir.
Yeah. Okay. What is capital budgeting? Anyone? Okay. And the third stage is sale of asset or closure of the project. Or closure of the project. So here, whatever may be the investment we did, okay, so the recovery of that investment, okay, like whatever the price amount we can get on sale of asset and release of working capital. Working capital. Okay. So this is at the end of the project. Okay. So these are the stages of the cash flow. In the first stage, what we do, we are investing the money. Second stage, we are drive the operation. And in third stage, whatever the investment we did, we start to release those investment. Okay. Yeah. Now we need to see how we are going to calculate the cash flow. Okay, so as we already discussed, like sell, no, first it is basically the initial investment. Then phase operation, and then closure. Okay, so in initial investment, we consider the zero. Operation is basically, say for it is a 10-year project, so 1 to 10 year, and the closure is on 10th year. That also you need to keep in mind. At the end of the 10th year, whatever may be the closure happened. Okay, why I gave it is 0, 1 to 10 and 10th year. Whenever I am using the discounting factor for initial investment, I always need to use the 1 as a discounting factor. For 1 to 10, there are several, like for first year, at the end of the first year, the discounting factor is different. At the end of the second year, the discounting factor is different. So like this, say for, if I consider the 10% as a discounting rate, so for first year, it is 0.91. Second year, it is 0.82. Third year, it is 0. Maybe the 72 or 78. Fourth year, it is 0.72. And the fifth year, it is 0.65, like this. Okay, as in the 10th year, if I consider 0.37, okay, so whenever I'm whatever the amount received after 10th year, I need to apply the last discounting factor. It is 0.37, like this. Okay, because I assume on the year end or the closure of the closure of the project, I am receiving all the money. So this way we are doing a capital budgeting. Okay, then you need to consider the pre-tax and post-tax. Okay, post-tax. Okay, this situation you need to consider for operation cycle and closure of the asset. Okay, for initial investment, there is no question of pre-tax and post-tax. Okay, because it is an investment, so there is no much tax benefit. But in operation, because of taxable income, oblique loss, okay, you need to consider the tax effect. And on the closure of the asset, means when you are selling the asset, at that time, there is a certain capital gain may arise or loss may arise. Okay, so because of that reason also, you need to consider the impact of taxes. Okay, pre-tax means before giving an effect of tax, effect of tax, and the post-tax is after giving an effect of tax. Effect of tax. Okay, that also you keep in mind. Sometimes we give a tax benefit only the phases during the operation and we forget or miss the tax impact for the at the time of closure of the project. Okay, so on closure of the project, if you sell the asset, there may be a certain capital gain or capital losses, so you need to consider the tax for that aspect as well. Okay, so we can see the here this example. So annual cash flow is 40,000. So like it is just for an operation we are considering right now. So annual cash flow is 40,000. Depreciation is 10,000 and the tax rate is 40%. 40%. If this is the situation, how we are going to calculate? 40,000 is my cash inflow minus 10,000 depreciation minus 10,000 depreciation. So my taxable income is 30,000. Income. Okay, and I need to pay the tax at 40%. So it is 12,000 tax. Okay, so it is basically the pre-tax. Okay, so my post-tax is basically the 18,000. This is post-tax. Okay, after that, because I deducted 10,000 non-cash expenses, so that I need to add back, which is 10,000. Okay, so my post-tax cash inflow 28,000. Okay, that I need to consider. You can do like this or line by line item, like income 40,000. So this is the cash. Okay, so I need to consider the for this item my tax is basically 16,000. 40%. Yeah. Okay. So, post-tax cash inflow is 24,000. For depreciation, okay, so it is basically the 10,000. Okay. So here what happened? I do not require to pay the tax. I'm going to save the tax, okay, which is basically the 4,000. And as this is only like this, I consider as a minus, and this I consider as a plus, okay. And only the tax impact I need to consider, because this is a non-cash expenses, so I need to add here, and this will be the 28,000. So either you can consider the impact of taxes on line by line item, or this way you can either calculate first taxable income, and then you need to add back all the non-cash expenses item. Okay, so this way you can calculate. Okay, and the pre-tax post-tax you can consider. So in exam they may give an information, this is basically the pre-tax, so then you need to consider the tax impact, and if they mention it is a post-tax, then you need to straightway take as it is. Okay. Okay, we'll take this example. So a divisional management of a curling company has proposed the purchase of new machine that will improve the efficiency of the operation in the company's manufacturing plant. The purchase price of the machine is price 4,25,000. Okay. Cost associated with putting the machine into services 10,000. So that I need to add. Installation cost I'll consider. Okay. Shipping 15,000. Okay, this is shipping cost actually. Then installation cost 15,000. And the 6,000 for initial training, 6,000 pre-operative initial training. Okay, so total outflow is basically 35 and 35 plus 15, 450, 456, 4,56,000. Okay, that's 6,000 actually. I need to check. Yeah, 4,56,000. Okay. Then Carlin expect the machine to last 6 years and have an estimated salvage value of 7,000. Okay. So like depreciation per year would be 4,56,000 minus 7. How much? 4,51,000. And the depreciation it is 75,166 approximately. Depreciation per year. Not 4,59,000, it is 4,49,000.
Sir,
49,000. 6, yeah. So 74,833 we consider. See, I'll see in later. Okay, so company expect, and then the machine is expected to produce 4,000 unit a year at an expected selling price is 800 per unit prime cost and 750 of 750 per unit. Okay, so total cost is basically 700 and 800, 750 and 800. The depreciation under the straight line rule. Okay, so no consideration for 5-year property with no consider the entire asset amount capitalized will be depreciated. Okay, so it is not like this. We do not require to consider this. 4,50,000, 56,000. So depreciation actually 4,56,000 divided by 5 because we need to consider the tax impact. So it is per year 91,200. As per the tax rule, we can depreciate in a 5 year basically. And then required to calculate the 0 and year to 5 and the 6 year, which is the final year. Okay. So first 0, then 1 to 6, 1 to 6, and the 6th year. Okay. In the first year, whatever may be the asset cost, which is 4,56,000, this is minus. Okay. First to 6th year, which is basically 800 minus 750 means if I consider the 50 multiplied by 4,000. So 200,000 is a per year cost, per year income. Yeah. 200,000 per year income and the tax rate is 40%. Just on it now. Yeah, for 56,000. This is like this, correct. Okay. So here what happened? 200,000 and the per year depreciation is 91,200. Okay. So my taxable income 180 and multiplied by 0.4 is my tax. Okay. So 65,280 is my taxable income and then I need to add back depreciation. So post tax cash flow is this amount 156,480. Okay. So this is, I'll just write, this is my net income, like selling price minus prime cost. Okay. This is my depreciation that I consider as per tax rule. Okay. Then this is taxable income. Okay. This is my tax amount at the rate of 40%. And this is post tax income. Then add back depreciation. Add back non-cash expenses. Okay, which gives me post-tax cash flow. Post-tax cash flow like this. This is for 1 to 5 year. Sorry, not 6 year. 1 to 5 year. For 6th year, it is like 200. Okay, but it is 0. Okay, taxable income as it is. Okay, tax rate is. Okay, so post-tax income is this minus this, 120,000. There is no add back of depreciation. So post-tax, my cash flow is 120,000. This is for 6th year. Okay, and then whether they gave the selling value or something. No. The cash flow at the beginning of the 0 and 1 to 5. Okay, so for like minus 456 is my for 0, then 156 480 for 1 to 5 year, and then in the 6th year, because we already consume all the tax benefit, by the end of 5th year. So 6th year I cannot claim the tax benefit, so I need to pay the tax on entire income. Okay, so this way we are going to calculate. Let's see, 456, then 156 480, and for the 6th year it is okay. So because yeah, that I forget. 6th year, when there is a salvage value of 7,000 for which I already claimed the depreciation, so that is my additional income. Okay, salvage value of 7,000, that means I am able to realize the 7,000, but like I already consume all the tax benefit, okay, by way of depreciation. So book value of the asset is 0. So that's why whatever may be the salvage value I am getting, that is basically the additional income for me. Okay, so the again tax on this 7,000 is this one, then the post tax this, and there is no add back, so we need to consider this. Okay, so on 6th year your cash flow is 124,200. Okay, so I hope you are able to understand this point. Okay, so it is basically the terminal value, I can say, because I am receiving a 7,000 for which the book value is 0. So entire receipt is my taxable income. Clear? If there is unabsorbed depreciation, then you can reduce the value of book value of the asset, and then you can calculate the tax impact. But here the book value is 0. So entire receipt against sale of the asset or the terminal value received, okay, that is considered as a taxable income. So we need to offer a tax on that income, and we need to consider post-tax cash flow. Clear? Okay, so here for 6th year, the amount is 124,200. 0 to 15, the amount is 156,480, and on a first year, it is 456,100. Okay. So sometime it is not necessary that you can claim all the year tax benefit. Okay. Sometime your tax benefit get exhausted earlier year. So in once the tax benefit is exhausted, then you need to calculate the taxes or pay the taxes on entire income. Okay. And then again, that aspect also you need to keep in mind when sometime, because the whether the asset gets sell or what happened, and because of that reason we are not paying a due attention, like I forget this time. So whenever there is a salvage value given, okay, and it is assumed that all tax benefit is exhausted, you need to consider the book value is a 0. Okay, and whatever may be the salvage value is basically the terminal income. Okay, and then you need to offer a tax on entire income. Say for here, if the book value is not 0, and in a question it is given that 3,000 is still unabsorbed. Okay, so in that situation, 7,000 minus 3,000, so 4,000, on that you need to calculate the taxes. So say for 40% is 1,600, so the tax amount is 2,400. Okay, so that you need to pay. Then your cash flow in that situation, 7,000 minus 2,400, which is like 006 3,600.
But if the question is silent and nothing is mentioned, so we are considering salvage value
Salvage value
before
is the
itself while
receipt.
calculating.
Yes, yes, yes. That we need to consider. Okay, so it is basically not 1,600 is a tax amount. So 7,000 minus 1,600. 0, 4, 5,400. Instead of 4,200, your value of the post tax, because of 3,000 is the book value available. Okay, so that's why your tax liability is reduced. Against 2,800, it is now 1,600. So that's why the post tax terminal value of receipt is basically, instead of 4,200, it is 5,400. Okay, so I hope you are able to understand this concept. Okay, now we need to see like how we calculate the discounted cash value. So now you need to consider 456,000. Okay, 156,400, 156,480. Okay, and the third 124,200 and 4,200. Okay, so you need to apply the separate discounting factor. So here, if I consider the 10% as a discounting factor, okay, so here for first year it is 1 always. For second year, for 5 years we need to calculate, because the same income for entire 5 years, so it is 1 divided by 1.1. You need to add all this, which is 3.79. Okay, and in examination they will give individual as well as the sum. Okay, for sixth year it is basically, okay, and the same you need to consider for the terminal value receipt. Okay, because it is assumed that at the end of the year you will realize all the value of the asset. Okay, while doing any capital budgeting. So now the net cash flow or the net present value is basically this multiplied by this I calculated, means if you see yearly amount multiplied by whatever may be the sum of discounting factor for 1 to 5 years, okay, which is 3.79. Then for the sixth year we calculate separately sixth year, because for sixth year the post tax income is different, and then the terminal value. Okay, and if I add together, this is basically 29660 is positive. Okay, so if it is positive, means you are able to recover higher amount than your investment. Okay, you are able to recover 6.65 against the investment of 4.56. That means you can take this project. Means you are able to earn minimum 10% amount, 100%, and or and above that 209,660. So that is basically the discounted cash flow. Okay, so the 10% which I took, okay, how we are going to calculate this 10%? Okay, and why we should take a 10%, not 15% or 18%? Okay, so we generally finance any project either by way of equity or debt. So equity includes preference shareholder and debt include the bank term loan. Clear? Okay, so first you need to calculate the weighted average cost of capital. What is weighted average cost of capital? Capital. Okay, so what is weighted average cost of capital? If your project required the 100 million investment, so that 100 million you can bifurcate in 3 to 4 situation. Like first, equity. Okay, so first equity, which is generally the highest or minimum 40% you can say, okay, or 40 million. Then preference equity, which is basically the 10%, 10 million. Then bank loan, that you can consider 20%, 20 million. And the retain earning is also again the part of equity, okay, which is 30%. Okay, altogether it is 100. Okay. Now every portion carries the different cost of capital. Like equity holders, okay, they may expect the 15% return. So it is generally on retain earning, and equity holders may expect a 15% return. Okay. Preference equity, they may expect the 10% return, and the bank loan, they may expect the, sorry, even less than preference equity. So it is 8%. Okay, clear? You can calculate the expected rate of return as per the CAPM model, which we saw yesterday. Risk-free rate of interest plus beta multiplied by market risk premium minus risk-free rate of return. Okay, you can calculate this way. In examination, whenever you need to calculate the weighted average cost of capital and they gave the beta, okay, that means you need to calculate the expected cost of equity. Okay, and the expected cost of equity is same to the retain earning most of the cases. Why? Because this is again, retain earning is basically whatever the accumulated profit. So this is again belongs to the common stockholder. Okay, so and the common stockholder for new infusion or the existing capital, mostly it is same. Okay, so that's why whatever may be the cost of equity, that you need to apply to the retain earning. Okay, so here see, for 40%, 15% and 30%, 15%, that means for 70% of total project cost, they expect 15% return. Okay, they expect 10% return. Okay, then remaining 20%, they expect 8% return. But if I consider, because that interest is tax deductible. Okay, so and if the tax rate is 30%, that means 8 minus 2.4, which is how much? 5.6%. Okay, so it is 5.6%. Are you able to understand? Debt is always the tax deductible. Okay, so you need to consider the cost of debt always like interest rate multiplied by 1 minus tax rate. Okay, preference shareholder, this is not tax deductible, non-tax deductible. Okay, so you need to consider as it is. This is as per the CAPM model. Okay, or if it is given, then you need to consider as it is, because this is again non-tax deductible. Only in case of the debt, you need to reduce the tax impact. Okay, so when the cost of debt is 8%, you need to reduce the tax can avail, and then you need to consider the post-tax benefit. Okay, so now again, like 70% is my 15%, 10% is with a 10% return, and the 20% is with a 5.6% return. Okay, so 15% of 7%, 70% is how much? 10.5. Okay, this is 10% of 10%, 1%, and the 5.6, it is basically uh, so which is 1.12%. With that also. Ten 10.5, yeah. Okay, and if I add together, so it is 11, 12, 12.17%. So that is my average cost of capital. Or weighted average cost of capital. Clear? Okay, so what I need to do here, whatever may be my the investment, okay, 100 million investment, in what form I'm getting the money and what is the expectation of my stakeholder. Okay, so I'm getting 40% as an fresh equity infusion plus 30% as a retained earning. So 70% belongs to the equity shareholder. Okay, and they expect the 15% return. Okay, preference equity holder, they are okay to invest 10% and we can take a bank loan of 20%. Okay, preference shareholder expecting a 10% return, as this dividend is non-tax deductible, so we do not require to make any adjustment. But bank loan, whatever may be the interest we are going to pay, that is tax deductible. So even though the bank loan carries 8% interest, okay, for me, as I'm getting a tax benefit, so that's why I need to reduce the tax amount from the interest rate. Okay, so for 8%, if I consider the tax rate of 30%, so it is 2.4%. So 8 minus 2.4, 5.6% I need to consider as a expected cost of capital for the bank term loan. Okay, and then I apply and I calculate the weighted average. So for 70%, the cost of capital is 15%. For 10%, the cost of capital is 10%. And the 20%, the cost of capital is 5.6%. So then 10.5 plus 1 and 1.12. So my average cost of capital is 12.17. And also keep in mind, your weighted average cost of capital always in between 15 to 5.6, means maximum expectation to minimum expectation. Okay, if by any chance it come around 20%, that means somewhere it is wrong. Okay, or 4%, that means it is somewhere is wrong. It is always lies between 15 and 5.6. Clear? Okay, so this weighted average cost of capital we need to consider as a discounting factor while evaluating the project. Okay, so here we consider the 10% as a discounting factor, but instead of that, like we need to consider 12.17% as an discounting factor. Okay, then you can calculate what would be your net present value. Means whatever may be the expectation of your investors, that you can already factored while calculating the net present value, and whatever may be the net present value received, this is after money available or the income available after satisfying your investors. Okay, so this way you need to calculate. So why we calculate the weighted average cost of capital? To understand what would be my discounted cash, what factor I need to consider for a discounting factor. Okay, when I can use the CAPM as a discounting factor, can anyone say? Anyone guess? With a capital asset pricing model, what we are going to calculate? We are going to calculate expected return of the equity holder. And I want to use only CAPM as a holder. Okay, and I want to use only CAPM as a discounting factor. Can you guess when this kind of situation arises? When entire amount financed by equity. Okay, with CAPM, what we are going to calculate expected return of the equity holder. Okay, if 100% financed by the equity, okay, then you can use the whatever may be the cost of equity as per the CAPM as a discounting factor. Okay, but if you are using the mix of sources like equity, preference equity, then bond or bank loan. Okay, so then you need to calculate the weighted average cost of capital. weighted average cost of capital. Any doubt, any issue? Okay, so we will take a 15-minute break here and then I start again. Okay. So yeah, then net present value. So net present value is basically initial investment that we need to deduct from discounted cash inflow. During operation and closure. Okay, so here, like in this example, when we saw this, okay, so my net investment is 4,56,000, and the discounted cash flow for the operation period and the closure is basically 665,560. Okay, and when I deduct 456,000 minus from 656,560, the net positive value is 209,660. So that is my net present value. Okay, so this is basically the net present value. Okay, so net present value is basically the cash inflow, discounted cash inflow minus initial investment. That also you can consider. NPV equals to discounted cash inflow minus initial investment. Okay, so that is basically the net present value. Okay, anyone has any issue? I mean, how to calculate the discounted cash flow? I mean, how to uh, like apply the discounting factor to the cash flow? Okay, hope I'm audible for everyone. Okay, so the calculation of net present value estimate all direct and indirect after tax cash flow, both inflow and outflow related to the investment, accounting for the depreciation tax shield, but ignoring financing cost already captured through the discounting process. Okay, so what happened in net income? There is a finance cost as well. Okay, that we need to ignore, not even required to consider for tax benefit. Tax benefit. Okay, so why we should not require to consider for tax benefit? Because when we calculate weighted average cost of capital, we already consider the cost of debt after tax benefit. Okay, so again, we do not require to consider the interest value or the financing cost. Discount all cash flow to present value using the appropriate discounting factor based on the hurdle rate and the timing of the cash flow. Okay, so why we are saying that hurdle rate, as we already discussed, if 100% equity, then whatever may be the capital asset pricing model, CAPM, and if there is a mix of investment, okay, so then we need to calculate the weighted average cost of capital. Okay, and the timing is basically means if the cash flow generate in a 1 year, so you need to consider the discounting factor for 1 year. If it is 2 year, then you need to consider that after 2 year, 3 year, 4 year, 5 year. Like if I consider the discounting factor for with at the rate of 10% for 1 year, first year it is 0.91, then 0.82, then 0.78, then 0.75 or 72, and then 0.62, like this. So depend on the timing of the cash flow, discounting factor get changes. Okay, hurdle rate is constant, but discounting factor get changes. And then compare the present value of inflow and outflow. So whatever may be the addition deletion of the present value of inflow and outflow, that is basically the net present value. Then discounted cash flow is the basis for net present value method. So calculate after tax cash flow, annual net cash flow multiplied by 1 minus tax rate. Then you need to add the tax shield on the depreciation, multiply result by the appropriate present value of an annuity, assuming cash flow or annuity, and subject initial cash inflow. Any issue with this? Okay. If NPV is positive, then what we need to do, and if NPV is negative, then what we need to do? What is the impact?
If it is positive, then it is good to invest in a project.
Good to invest. And if it is negative,
Not a-
not good to invest. Okay. See, invest. Beside this, if it is positive, that means whatever may be the expected rate of return that we are able to achieve. And if it is negative, then we cannot achieve. Okay, it is not the immediate interpretation not to invest, then we need to make certain adjustment. Cannot achieve. Okay, so because see, if I consider the before discounting cash flow, so sometime it may be the positive, but when I apply the discounting factor, okay, so it goes negative. Why it goes negative? Because I'm earning whatever may be the my expected rate of return, that also factor while calculating the discounting factor. Okay, so if it is positive, that means whatever may be my expected rate of return that I am going to achieve, no problem. But if it is negative, then the first interpretation is whatever may be my expected rate of return that I cannot achieve. Okay, so then we need to see what can we can do. Okay. So, if I understand that it is a negative, no, first I will go with the like what we consider basically while calculating the hurdle rate. Okay, with WACC, weighted average cost of capital, it is basically the bare minimum, cost of capital. Okay, like investor need that much, shareholder need that much return. Interest we need to pay because it is a committed one. So it is a bare minimum cost of capital. Okay, so while calculating the hurdle rate, we need to also factor the risk associated with the project. And if it is the project, and if it is the high risk project, then we need to add a risk premium. Okay, so bare minimum cost of capital, whatever may be the weighted average, then I add the risk premium. Second issue, I mean, sometime like the aggressive investor mostly do this. They may feel if I invest this amount here instead of in this project, if I invest somewhere else, then I may get some additional earning. Okay, say for risk-free rate of return. Okay, so that also I need to then factor here. Say for risk-free rate of return. Okay, so that also you need to consider. Okay, so it is purely the management call. Okay, so a higher hurdle rate discounted. Okay, so this way we need to consider the hurdle rate. Okay, so weighted average cost of capital, it is the bare minimum which I need to pay to my investor. Then risk is high, then I need to add some risk premium and additional earning. I mean, if I invest some other project, then I may earn additional earning on that project. So for that also I need to add something. Okay. So like if I consider the 12.17 as my weighted average cost of capital, okay, 5% and the 3%. So it is 20.17. Okay. If I calculate the discounting discounted cash flow with the 12.17 and 20.17, what would be the impact? Means if I calculate with 12.17 discounting factor, so value of the discounted cash flow or the total of discounted cash flow high or low if I use 12.17 instead of 20.17. Okay, can you answer? Like the discounted cash flow with a hurdle rate of 20.17 is higher, or the discounted cash flow with the hurdle of 20.17 is higher. Any guess? Option 1 high, option 2 low. Can you guess? Maybe it is right, wrong, no problem. Whether it is high or low. Or discounted cash flow directly proportion to hurdle rate or inversely proportion to hurdle rate. Any guess? Discounted cash flow is high if the hurdle rate is, you need to select either of this. So, I mean, just you need to guess, that is also okay. Okay. So, discounted cash flow is high if hurdle rate is low. Why? Because if my expected return is less, okay, so I need to, I do not require to accommodate much cost of capital, and in that situation, I am getting an higher value. Okay, like you can consider 10,000 with a discounting factor for 1 year only, 1 divided by 1.1, and with a discounting factor 1 divided by 1.15. Okay, so it is always high for the at 10% and it is low at 15%. Why? Because here I want to accommodate 15% return on investment. So that's why the leftover amount is low. And here I need to accommodate 10% return on investment. So that's why amount is high. So discounted cash flow is always high if hurdle rate is low. Okay, so accordingly you need to decide. Okay. Then different rate may be used for different time period using NPV method. For example, 12% might be rate for the first 3 years and 15% might be the rate for subsequent years. If the NPV is greater than 0, the project will be acceptable. So it is not necessary the one discounting factor you need to apply across the project. Okay, you can use the different discounting rate for every year. Okay, so like maybe means if there is a economic recession, okay, and in that situation you want your expected return for that year may go down. Okay, so you can reduce the hurdle rate. Okay, for that year, because we are generally calculating on year-to-year basis. So NPV method of capital investment valuation is considered to be superior to the internal rate of return method, because it is flexible enough to handle inconsistent return for each year of the project. Okay. IRR is basically the internal rate of return. Okay, so IRR is discounting factor where NPV is 0, net present value is equals to 0. That is the IRR. Okay, so we generally use the NPV so that we come to know at what level we can satisfy our investor. If we just go with the IRR, okay, I tell you something. Like there is a project 1, project 2, and the project 3. Okay, it requires the investment of 4 lakh. Okay, and it gives the like IRR of 12%. This is 15 lakh, IRR of 10%, and this is say for 5 lakh, which gives the IRR of 20%. Okay, so in this project, if I go with this IRR, this one, okay, or this one, okay, so in that situation, I may invest with the a little amount. Okay, if I am okay to earn 8%, and the second one which give, and I have a infinite amount, okay, so it is better to go with this, because in absolute terms I am able to earn more. Okay, so that's why you need to compare all the project with the expected rate of return instead of IRR. IRR means whatever the return generated by the business. Okay, so instead of that, you need to consider the expected rate of return, and then you need to evaluate how much amount you can earn in absolute term as well. Okay, so that's why NPV is more preferable than the IRR method. Okay, so any issue with NPV, IRR, any terminology, whatever we discussed till now? Okay, so discount rate applied to qualitatively desirable or non-optional investment. A project that meets qualitative management criteria for investment, that is mandated technology investment, is subject to financing rather than capital budgeting consideration. In this case, the discount rate used for NPV evaluation should be the after-tax cost of borrowing, sometimes called the incremental borrowing rate. Okay, we need to do some investment for value addition purpose. Okay, purpose. Earlier we are producing 40,000 unit. Okay, now we are producing 80,000 unit because of some modernization. Okay, so what happened? Whatever may be the incremental earning, that we need to discount. Okay, and for that we need to use the bank financing cost, or like weighted average cost of capital. Here we are not going to apply any like risk premium or something like that, because it is a, because whatever maybe the our total profit arises, okay, so that we may be factor, but whatever may be the investment we are doing for increasing output, that always we need to discount with the incremental borrowing rate. Okay, So because we are comparing incremental income with the incremental expenses only. Okay, so we'll take an example. Maclean Inc. is considering a purchase of new machine which will cost 150,000. The machine has an estimated useful life of 3 years. Assume for simplicity that equipment will be fully depreciated for tax purpose, 30%, 40% and 30%. The new machine will have a 10,000 resale value at the end of estimated useful life. The machine is expected to save the company 85,000 per year operating expenses. So incremental earning is 85,000. Okay, even though it is a saving, we need to consider this as a earning. Okay, so Maclean uses 40% estimated tax rate and a 16% hurdle rate to evaluate the capital project. 16% you can assume it is weighted average cost of capital or bank financing, means incremental borrowing. Okay, 85,000 is my income. Okay, then my expenses is basically only the depreciation that we need to consider. So I'll just consider like here, because different tax rate, 85,000, 85,000, 85,000. Okay, also as we already discussed, 100% depreciated, but there is a resale value of the 10,000 at the end of the year. So that also we need to consider. This will be my entire income. Okay, so first year, second year, third year, even third year. Okay, then my cost is 150,000 fixed asset. Okay, so which is depreciated with a 30%. 0.3, 45,000, 45,000 and maybe 60,000 like this. Okay, so my taxable income again, this is, then I need to charge 40% income tax, 0.4, post tax cash flow, this minus this, add back depreciation. And then I need to apply the discounting factor. For third year, it is the same. Okay. So then 69,000 multiplied by 86, this one. So my total net cash inflow is this one, which is 163. And then my investment is 1,50,000. So net present value is 13,269. Okay. So again, I'll write here. This is all my income. Okay, saving in expenses because of installation of machine is basically the income generated. Okay, then it is depreciation at the rate of 30%, 40%, 30%. So it is taxable income. Okay, then the tax amount at 40%. Okay, then this is my after tax income. And then it is add back depreciation. Add back depreciation, I have not separately mentioned. Add back depreciation and post tax cash flow. Okay, so basically what happened here, I need to directly add back the depreciation, 24,000 plus 40,000. Okay, so it is after add back depreciation, post tax cash flow, and then the discounting factor. at 16%, and this is the discounted cash flow. Cash flow, which will give the discounted cash flow 163,269 with a 16%, and 150,000 is my initial investment. So 13,000 is positive net present value. We can see here. Okay, so this way you will get the information in an examination as well. Thirteen to 78, some maybe because of 478, 270. This may be a rounding off issue. Okay, so this way also you can calculate. Means here they gave the calculation. They first, what is the tax shield? 18,000 and 24,000 because of depreciation, and then 51,000 is yearly income after depreciation, and tax cash flow 6,000 is on a cash flow for the third year, which we took here as well. So 150,000 depreciation, tax shield 81,000 and 15. So 6975 75 6975. Why it is 69? Okay, yeah, 69 plus 6, this one, this way. So it is 75,000 on third year. Okay, and then we need to apply the discounting factor. So it is mainly because of rounding off. Okay, so it is 55732 44205, and this way we need to calculate, and then we need to deduct the initial investment. So whatever may be, this is my net cash value, net present value. So here what happened, we have not entered into the new operation, but we invested some amount so that we can improve the efficiency. So whatever may be the saving, that we need to consider as a income. Okay, and if it is given that entire amount is financed by the bank, okay, so you need to consider the interest rate as a hurdle rate. Okay, but that interest rate should be after the tax benefit. Okay, like say for they say 16% is my bank interest rate and the 14% is tax rate. Okay, so you need to consider the 60% of the 16%, 1 minus means 9.6%, that you need to keep in mind. Okay, are you able to understand what I'm trying to explain? Like if in the question it is given the bank interest rate is 16% and entire amount is financed with a bank interest. Okay, so what is your hurdle rate? As the tax rate given is 40%, so 16% multiplied by 1 minus tax rate. Okay, so 16% multiplied by 60%, because the interest is tax deductible, so it is 9.6%, and then you need to calculate the discounting factor, that you need to consider as a discounting rate. Are you able to understand this situation? If in the examination they gave the interest rate, always you need to consider the interest rate after the tax benefit. Okay, if they say the post tax interest rate is this one, then you need to take it as it is. But if they say the pre tax interest rate is this one, or they have not given any information whether it is pre-tax or post-tax, so then you need to assume it is a pre-tax and you need to reduce the tax shield percentage while considering the discounting factor. Okay. So what are the advantages and disadvantages of net present value? So capital rationing. So if you have an infinite fund, okay, then you can consider all the project with positive NPV. If you have an limited capital, okay, then what you need to do? With the maximum net present value. Okay, maximum net present value means if you have a first where you need to invest the 5 lakh, this will give the net present value of 1 lakh. Then the second investment 10 lakh, this will give the value of maybe the 3 lakh. Okay, and the third one is 8 lakh, this may give the value of 4 lakh. Okay, and if you have an value of 5 lakh only, then you have no choice, then you need to use this one. If you have a 10 lakh or 8 lakh, okay, so then you can, even if you have a 10 lakh, you can use this one, because of with a 8 lakh investment you are able to generate the 4 lakh. Okay, like this. Okay, now this is basically the investment, this is basically the NPV. Okay, so what would be the present value of cash inflow? 5 plus 1, 6 lakh, 10 plus 3, 13, and the 8 plus 4, 12. Okay, now we need to see the profitability index. Okay, so this is, just keep in mind, if it is a net present value, so then it is a present value that you need to consider. Okay, profitability index for first project, second project, and third project. Okay, the formula is present value of cash inflow divided by outflow or investment. Okay, that we are using for ranking purpose. Okay, so if you see here, like the present value of cash inflow is 6 lakh and the investment is 5 lakh. Okay, so 6 divided by 5, then present value of 13 and investment is 10. 13 divided by 10, and here 12 divided by 8. Okay, now we need to calculate. Plus 6 divided by 5, 13 divided by 10, and 12 divided by 8. Okay, 1.5. So this is most preferable project. Means this is the priority 1, this is priority 2, and this is priority 3. Now you can see. So profitability index is the ratio of the present value of the net future cash flow to the present value of the net initial investment. Okay, so because this is the only first year investment, that's why I just write the investment. Otherwise, this is also the present value of investment. Okay, so the profitability is also referred to as the excess present value index or simply the present value index. Ranking and selection of investment alternative anticipate positive net present value for all successfully screened investment. Means if it is positive, then and only. If it is less than 1, that means it is a negative. The profitability ratio likely will be over 1, which means that the present value of the inflow is greater than the present value of outflow. So you need to select only those projects which gives you the profitability index which is more than 1. Application, the profitability index measure cash flow return per dollar invested. The higher the profitability index, the more desirable product. Okay, so here 1.5, that means you need to first opt for this product. Okay, so limited capital resources are applied in order of the index until the resources are either exhausted or investment required. Okay, so now if you have we'll see this example here. If you have an investment of 10 lakh, okay, so you need to first priority this one. Okay, after that you cannot select this or this because it requires the 5 lakh and it requires the 10 lakh. Okay, so in that situation you can go with this only. Okay, so this way you can decide which project you need to go. Sometime what happened with a similar investment means the 5 lakh investment which will give you the 6 lakh net present value of cash inflow, 5 lakh investment which will give a 5 lakh 50,000. Okay, so here 1.2 and maybe this is 1.1 like this. Okay, so you need to go with this. So you need to select this project like this. Okay, and this way you can utilize the profitability index. So we will see this example. So they gave the initial investment and the present value. They have a 50,000 only. Okay. So we need to first calculate the profitability index. Okay. So 5 project, 1, 2, 3, 4, 5. Okay. 5. I'll not write everything. I'll just calculate the profit. What is my profitability index? Present value of inflow, like 25 in the first case, divide by initial investment, divide by 16. Okay, so 1.56. Then 7 divided by 4. Then 38 divided by 30. Then 11 divided by 8. And then 42 divided by 25. Okay, so these are my profitability index. Okay, so now I need to rank as per the profitability index. So this is first. Okay, then this is second, this is third, this is fourth, and this is fifth. I have a total 50,000. Okay, so first I need to select which require the 4,000 investment. Okay, then second is last one which requires the 25,000 investment. Then the third one is this one which requires the 16,000 investment. Okay, so it is 20 plus 25, 45. Now I don't have any option because now the available amount is 5,000. So already 16, 4 and 25 is selected. So I cannot invest in project C and project D. So I need to stop myself. Let's see. 45,000. Yeah, BEA that I need to select, and now I don't have a surplus amount. So I need to stop myself. Clear? So this way we can evaluate where I need to invest first. Okay, and this profitability index mostly we are using where the similar investment giving you the different discounted cash flow. At that time we need to evaluate this. So here we need to like invest 45,000 only. Okay. Any doubt here? Profitability index, net present value. No. Now we see the different scenarios. Lease versus buy decision. Okay. Lease versus buy decision for application of NPV. Okay. So how we are going to decide it? Okay. First we go with this chart. Does the asset gives the operational benefit? And is it cheaper to buy or lease? focus on the NPV after tax cash inflow, focus on the relative benefit of tax allowable depreciation and discounted cash flow. Okay, so in investment, when you are doing an investment, we need to consider weighted average cost of capital as a hurdle rate, and then we calculate the net present value. Okay, but in this situation, if it is whether we need to go for an investment or not, okay, but if I'm getting an NPV positive, okay, then the second alternate arises whether I need to really invest or lease out. Means I here I decided, okay, project is on, okay, but further evaluation is whether I need to invest entire amount in one go, or by taking a lease stage wise. That is the second evaluation. Okay, so lease or investment, that we are going to discuss. Okay, so with the lease investment strategy, we are considering the purchase cost, tax saving from the depreciation, and the scrap proceeds. I mean, the way we calculate. Okay, in lease there may be not the initial investment, but there is an additional recurring expenses, and then the tax saving. Okay, so when we are doing an investment, okay, we calculated the discounted cash outflow for installment and interest payment. Not okay, for banking maybe, but for investment it is basically the upfront payment and plus tax benefit on depreciation. We are not calculating the income. Okay, and then for the lease we are calculating the recurring lease payment plus tax saving. Okay, say for if I have an asset worth 10 lakh, okay, I invested the entire amount. Okay, bank financing I will see later on. At 10 lakh, I invested the all amount. Okay, so every year I am getting a 20% depreciation. Okay, so first 10 lakh is a 0 year, second year, and the tax rate is 40%. So 20% means 2 to 5 years, sorry, 1 to 5 years, 2 lakh rupees per year, basically my depreciation, 2 lakh, and the 40% is tax rate. Okay, 40% is tax rate. So what saving I am getting? Uh, Mhm. Okay. So, am I audible properly?
Yes, sir.
Okay, okay. So we will take this example and then maybe close. Okay, so in this example, see what happened. We are evaluating lease financing with the own investment. Okay, so even though the hurdle rate is 9%, but we need to use the bank interest rate. Okay, because you are not evaluating the earning, we are evaluating the option, and for which whatever may be the incremental cost that you need to consider. So we need to use the 7% here. Okay, so operating inflow, the asset will cost 200,000 and scrap value is 25,000 at the end of year 2. Operating inflow are same for both the situations, so we need to ignore this information. Okay, so first we calculate bank finance. So in 0, 1 and 2, so first outflow is minus 200,000. Okay, that information we need to ignore. Operating inflow, the tax rate is 30% and the company's weighted average cost of capital is 9%. So that also we need to ignore because it is the investors expectation, but that we are not calculating. We are evaluating the two alternative. So machine is fully depreciated on straight line basis over 2 years for book and tax purpose. Okay, so here I need to consider the 1 lakh each year, but I am able to get the tax benefit of 30%. Okay, so this is 30,000 and 30,000. These are my benefit. And the scrap value is 25,000. So on second year, 25,000 multiplied by 0.7 means what I did here, I am reducing the tax amount. Means 25,000 is my income because it is fully depreciated in 2 years, but I should consider the income as a 17,000 because I need to pay the 30% tax. So 70% of 25,000 that I need to consider, which is 17,500. 70% of 25,000. Okay, that you need to consider. Okay, so total income here, sorry, okay, just a minute, it is not visible, sorry. Yeah, okay, so what I did, again I'll explain. 200,000 is my initial investment, and then 30,000 is basically the depreciation. I mean, how I calculate is 1 lakh each year depreciation. Okay, tax shield on depreciation. Okay, so 1 lakh depreciation is non-cash, but whatever may be the tax benefit I'm getting, that I need to consider. So it is basically the 1 lakh multiplied by 30%. 30% is my tax rate. Okay, and 1 lakh is depreciation. Okay, so 30,000, 30,000, then 25,000 is my terminal value. So after deducting the tax, because tax I need to pay, the net income is 17,500. Okay, so minus 200,000, 30,000, 30,000 and 17,500. The total is 122,500. Okay, so that is my net outflow if I go with the investment. Okay, then financing option for the interest rate, bank loan 10% interest rate. Okay, so why I took the okay, discounting factor I will consider. Okay, so 10% is bank interest rate. Okay, so as I said, 30% we are getting the tax benefit, so we need to consider the discounting factor of 7%. Okay, and they gave the information PV of annuity due is 7%. Okay, so for individual year, for year 1 and year 2, 935 and 872, and for both the year, means the total is also given. Okay, so here I can apply individually. Otherwise, 30,000 multiplied by 1.935 also you can do it. Okay, 0.935 and 0.873, and the same is here 0.873. Then the discounted cash outflow or inflow. Okay, here I need to consider the 1. So my discounted value is this one, which is 130,483. Okay, clear on this issue? Okay, so see, if you add together, okay, so that amount is basically the 1.935. Okay, but in that situation, 30,000 multiplied by 1.935, that's what you need to do. Okay, but here I plotted individually, so that's why I applied the individual rate. Okay, so this is 130,483. Okay, if I consider on a lease basis, so my outflow per year is 92,500, 92,500. There is no question of depreciation, multiplied by 0.7 because I'm getting a tax benefit. And why I'm doing a minus? Because every year it is an outflow. Clear with this? How I calculated 64,500? 92,500 is my lease. Okay. And 30% I can get the benefit. So I need to consider the 70% only. This amount I calculated 92,500 multiplied by 70%, which is basically 1 minus 30%. Okay, which is 64,750. Okay, again, the discounting rate is 0.935 and 0.873. Okay, so like my value is this multiplied by this. So here also you can apply the again 1.935 for 67,500, but 117,068. Okay, so if I take an investment, if I invest the amount, then I need my discounted net outflow is 130,483, and if I on a lease basis, then my discounted net outflow is 17068. So which option is better? Any guess? This is the first option. Second option. Any guess? I mean, like 130 is a better one or 170 is better one? As this is the outflow, we need to consider with a lesser outflow. So this option is the better one. Second one. Here we need to pay 117,068 present value, and here 130,483. Okay. So see, the benefit of discounting factor is basically we are calculating the present value. So we nullify the impact of any postponement payment. Okay. So that's why the 17068 is the desirable option. Let's see. Okay, 125. I think There is some error, I think 1.935, 0.935 and 0.873. 18828. So here basically, I mean, if you add together, then it should be 1.808, but here they gave 1.935. So that is a mistake. Generally, it should be the total. Okay. So if you see the PV value of 5904. Okay. So project should be financed using the operating lease because the NPV of the cost is lower. Okay. So cost is lower. So that's why we need to go with the lease option. Okay. Have you able to understand why the differences arise? Okay. 1.935 is should be the total of these two. So that is 1.808. Okay. So that is somewhere there may be an error here. Okay. So the amount should be 117068. Okay. So are you able to understand this net present value and all the concept, or it is fine complicated? Yeah. Any input? Okay. So if no input, then we close the class for now. Okay. So bye everyone.